Welcome to PhillipCapital's weekly market watch. Last week has been one of much negative sentiment in market, and investors have reacted accordingly. Today, we have Ms. Hilary Ho, investment analyst from Phillips Securities Unit Trust Department, to share with us her views on the current situation and what she expects to affect the markets in the near term. So Hilary, what have caused the decline in equities recently?
Okay, there were a few negative elements at play. On the one hand, we have China heightening their efforts to rein in soaring credit growth. The Chinese authorities are striving to limit the amount of loans granted for 2010 to a maximum of renminbi 7.5 trillion. To achieve their target, they have increased the reserve required ratio, instructed banks to stop granting loans for the rest of the months, and in the latest measure, they have resorted to getting banks to recall some of the loans granted. And on the other hand, we also have President Obama wanting to limit the size and trading operations of big banks. All these measures are deemed detrimental to the global economic recovery.
Do you think there could be further pressure on equities as a result of these measures?
Okay, well, we do think that many are expecting further decline in equities due to these measures. Firstly, we do see the determination of the Chinese authorities to rein in the amount of loans granted. As such, there could be more measures to achieve this target. And secondly, there is probably still some uncertainty with regards to whether President Obama will be successful in meeting out his plan to limit the size and trading operations of banks. Hence, should there be further news of the plan, we can potentially expect some reactions in the market.
Do you see the decline as the start of another massive sell-off?
Okay, as mentioned earlier, we do expect further decline in equities due to these measures. However, we do not think that these measures will lead to a sell-off that is to the extent of what was seen in 2008. The impact of these measures will probably be temporary in nature. Firstly, in the context of China, the fall can be seen as a traditional reaction to the normalization of monetary policy. In the long run, growth prospect of the economy will still drive the market further. And secondly, with regards to President Obama's plan, we think the difficulties in passing a bill should not be underestimated. And also, judging from the amount of loans granted, the banking sector is still weak. Therefore, the relevant authorities might not be willing to weaken the banking sector immediately, given that the economy is still rather fragile at this moment.
What are the other factors that could impact the stock market in the near term?
Okay, of late we have seen a strengthening of the US dollar. Known to most, the rally so far has largely been supported by the dollar carry trade. Therefore, in the near term, if the dollar continues to strengthen, we can expect Asian markets to be affected. In this scenario, funds will start to flow out of this region and back to the developed economies.
You mentioned that the factors affecting the market currently are probably temporary in nature. So, what can be a real concern for the equity markets?
Okay, we think what could possibly trigger another massive sell-off is probably disappointing macroeconomic data. Recently, we have seen how certain data such as new home sales and jobless claims has begun to disappoint. Okay, this number serves as a wake-up call that the recovery was somewhat artificial and the economy remains in a fragile stage.
Thank you, Hilary. That's all we have for you this week. Please tune in next week for more market updates.